Title: Japan faces a brutal choice. Let the yen bleed or risk debt blowout. Flint West reporting. Summary statement. Japan is trapped. For more than 3 decades, it has attempted to solve a growth problem with monetary policy. The result is a debt pile exceeding 250% of gross domestic product, with the Bank of Japan now holding more than half of all Japanese government bonds. Meanwhile, an aging population still needs yield, and yield has gone elsewhere. Japanese institutions increasingly send capital overseas in search of returns, powering the yen carry trade and hammering the currency to approximately 160 to 162 yen per United States dollar. Raise rates to defend the yen and stem capital flight? Risk crushing debt servicing costs and fiscal blowout. Let the yen bleed? Face soaring United States dollar energy costs, imported inflation, eroded purchasing power, and surging bankruptcies. Even 2026's hike to 1% changed little. Exporters win. The rest suffocates. The brutal choice endures. Section 1. Contextual cloud. Start with the dilemma, because everything else sits downstream of it. Japan is attempting to do 2 things simultaneously. It must preserve the purchasing power of its currency, and it must preserve the sustainability of its debt. Increasingly, those 2 objectives appear to be moving in opposite directions. That is the trap. Section 2. The story begins more than 30 years ago. Following the 1985 Plaza Accord and the collapse of its asset bubble in the early 1990s, Japan entered what became known as its lost decades. Growth slowed, deflation took hold, interest rates collapsed. Monetary easing became a permanent feature of the economic landscape. Today, we can observe the consequences of that long-running experiment. Japan's public debt now exceeds 250% of gross domestic product, while the Bank of Japan has become the dominant holder of Japanese government bonds, holding more than 50% in recent years. For decades, ultra-low domestic yields have forced institutional investors and pension funds to look elsewhere for returns. And that matters, because Japan is not merely an economy. It is also an aging society. Its retirees still require positive returns, its pension systems still require yield, and capital behaves exactly as we should expect it to behave. It moves toward opportunity. Increasingly, that opportunity has existed overseas. This content is brought to you by Bobby Gigs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 3. Japanese institutions have parked massive amounts of capital abroad, particularly in United States assets, where higher yields remain available. The result has been persistent capital outflows, amplified by the yen carry trade and reflected in a chronically weak currency hovering near 160 to 162 yen per United States dollar despite interventions. This brings us to Japan's brutal choice. Suppose Japan decides to defend the yen. The solution appears straightforward. Raise interest rates. Higher domestic yields would attract capital home, support retirees, narrow the differential with United States markets, and reduce the incentives that continue to power the carry trade. But nothing is free. Higher rates also mean higher debt servicing costs on new issuance and debt rollovers. Given the sheer scale of Japan's obligations, aggressive tightening risks, fiscal strain, bond market volatility, and recessionary pressures, the cure itself begins to resemble the disease. Conversely, Japan could tolerate further yen weakness. That path preserves low borrowing costs and continues to support exporters whose foreign revenues become more valuable when translated back into yen. But once again, nothing is free. Section 4. Japan remains heavily dependent upon imported energy and commodities, much of which is priced in United States dollars. A weaker yen, therefore, carries consequences far beyond foreign exchange markets. Energy becomes more expensive, imported inflation rises, household purchasing power deteriorates, domestic businesses see their margins squeezed, and bankruptcy pressures continue to build, particularly among smaller and import-dependent firms. The pain is not distributed equally. Exporters often benefit. The broader economy frequently does not. The Bank of Japan understands this dilemma better than anyone. Its response throughout 2026 has been gradual normalization rather than aggressive tightening. The policy rate has risen to 1%, the highest level since 1995, yet the yen remains under pressure as yield differentials persist. That outcome should perhaps not surprise us. Japan's challenges were not created overnight, and they will not be resolved overnight. Nor is this necessarily an imminent collapse story. Japan possesses significant buffers. It retains substantial foreign exchange reserves. Its debt remains overwhelmingly domestically owned, and policymakers have demonstrated extraordinary patience over several decades in managing gradual rather than abrupt change. This is not an economy standing at the edge of a cliff. It is an economy walking a very narrow path. The deeper problem is therefore not monetary, it is structural. Japan is confronting a chronic policy trilemma of fiscal dominance, demographic demands, and external rate pressures. Section 5. Monetary policy may help manage the symptoms, but it cannot, by itself, manufacture sustainable growth. That must come from somewhere else. For now, however, the dilemma remains unchanged. Defend the currency and risk fiscal pain. Preserve fiscal stability and tolerate the erosion of purchasing power. Neither choice is painless. And that is what makes Japan's predicament so remarkable. After more than 3 decades of extraordinary monetary experimentation, the world's 4th largest economy still finds itself confronting the same fundamental question. How do you simultaneously preserve purchasing power, fiscal sustainability, and positive real returns when achieving one increasingly appears to come at the expense of the others? For Japan, that question remains unanswered. The brutal choice endures. Flint West signing off.